Is it finally time for some action on inflation after the Fed has been talking up all kinds of hawkishness this week? Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And it's time to put the Fed's money where its mouth is, or at least to think about how that's going to look. We end the week here with the PCE inflation number, which is, of course, the Fed's favored inflation gauge, which you might be tempted to think doesn't matter because, of course, we've already had CPI out. We know where things are going. We've already heard from the Fed ad nauseum over the past 3 weeks. Jay Powell has done nothing but stand in front of a microphone since the mid-June policy meeting. And yet, just today, we got to the third revision of second quarter GDP numbers, which almost never do anything. Because by the time they come out, the thing is an afterthought. And yet, here we are, looking at the markets cheering and yields going higher. So let's not write off PCE just yet. Let's have a look at what this might do in a market that is clearly very reactive across asset classes to anything that smells like it might beckon Fed action this way or that, and continues to shape this trade-off that the markets are trying to wrestle with between containing inflation and risking recession. So first, let's get a sense of the state of things. And as ever, this continues to be the main question. We, of course, have had disinflation as scheduled. There's the PCE. You can see it declining there from just over 6%, ultimately peaking just under 7%. And coming down, expected to register down from 4.4 to 3.8% year on year at headline. You can see that's been about 2 months lagged behind the market's own inflation expectations. We have two versions of them here. The 1-year USD inflation swap is giving us one perspective over a 1-year window. The 2-year break even is coming from the bond market. That's the difference between nominal and inflation adjusted yields for that time tenor. When you take the difference between them, the residual you get is the bond market's inflation expectation. So you can see here that market outlook seems to front run realized data by about 2 months, give or take. And that makes sense, of course. Data takes time to collect, and markets are inherently forward looking. So you can see here the general outlines of how this works. The issue for the Fed in looking at this is that inflation expectations over recent months have essentially stopped falling. In particular, if you look at the 1-year swap. So on the one hand, the market is saying all of the tightening that the Fed has already done, all of the rate hikes that are already in the system, will in fact bring us to inflation target within a reasonable window for the Fed, within 2 years. That's right within the Fed's outlook window. So good, one would think. Except it doesn't give the Fed any wiggle room whatsoever. And not surprisingly, if this is leading by 2 months, the Fed is concerned that if it stopped moving lower, then perhaps actual CPI is due to begin idling. Actual PCE is due to begin idling. And progress will run into a wall, locking into expectations inflation that is too high, which is not what the Fed wants to happen, clearly. Inflation expectations are easily a bigger concern than actual inflation. By the time it's realized, it's already something that's a condition on the ground that consumers are already reckoning with. What the Fed would like to do is to make sure that they don't then extrapolate price gains in their planning for the future, and in doing that, start to restrict economic activity and have that become a lasting headwind for growth over time. So what they would like, ostensibly, is to have these inflation expectation numbers overshooting on the downside, so that as the Fed lands the economy and lands inflation, it can cut rates into bringing them higher. Because, of course, at the current setting, the slightest inflationary shock takes the Fed off target and beckons a harder clamp down than arguably the Fed wants to do. They've already given us something of a late start to this tightening cycle, expecting inflation to have been more transitory than of course, it's turned out. And, of course, as we've argued here on Macro Money, going all the way back to the first half of 2021 in sort of various ways. And so we have here a situation where if the Fed doesn't want to be behind the ball, the thing to do might be to tighten harder now. And of course, that raises important questions about how much this PCE data might inspire action, at least in the minds of investors. Now, why is this set of expectations holding up here? Why aren't the markets looking at inflation going any lower given the hawkish Fed rhetoric? Let's see how it got here so far. We've looked at this before. You can see the Fed's actions to slow global growth are indeed helping to curb inflation. So what the Fed does in raising interest rates is it increases the cost of borrowing dollars. Dollars are overwhelmingly the medium of exchange for global commerce. Bank of International Settlements has the dollar's share in settling monetary transactions at around 88% in the latest data. So when you increase the cost of borrowing dollars, you're ostensibly increasing the cost of financing economic activity essentially everywhere, not just in the U.S., but in virtually every pocket of the global economic system that is in any way connected into the whole. So I suppose we can exclude North Korea. I suppose there's an increasing question about Russia, maybe about Iran. But when you increase the cost of borrowing dollars in all but those very specific cases, there is a rise in borrowing costs that you might expect. Not surprisingly, making economic activity more expensive to finance has slowed that activity. And so here you can see that total global trade volumes have been declining right alongside the PCE index. And if the PCE index is any telling, then the data on trade will backfill to show still further decline. Another part of this is, of course, mending supply chains. You can see that, too, is probably very helpful here. The Baltic Dry Index of shipping cost is back down to pre-pandemic levels, and the latest PPI data is showing us that the cost of moving goods around the U.S. economy, the U.S. supply chain, intermediate goods moving around from spot to spot as they get finished, and then those finished goods moving from where they're done to where they'll be sold, all of that has dropped back substantially and is arguably at this point reflecting conditions where the growth, at least in these costs, is either back down to pre-pandemic levels or even lower, and in the case of intermediate goods, is actually contracting, is actually a disinflationary force at this point. So whatever there is left to be done here seems to be on the cooling growth side, because the efficiency of supply chain side appears to have had all the juice squeezed from it as it stands. And so now what you're left with is having to do more on inflation to actually hurt growth, to actually reduce demand. And you can see that in spades here. It was exactly this, as a matter of fact, in a nice bit of validation, that Jay Powell has been talking about all week at the Sintra Portugal symposium that the ECB holds, the ECB Central Bank Forum. It's their version of the Jackson Hole gathering that the Fed does once a year, where they collect all manner of monetary policy bigwigs. Of course, the heads of all the major central banks come, representatives from the IMF, the World Bank, other key figures in the international space on central banking. And Powell has been opining there all week and specifically spoke to exactly this, that what you have is an economy that is overwhelmingly the service sector. And it's in the service sector that inflation is having a hard time coming down. The service sector is also the top employer in the U.S. economy, as it is in most major developed economies. And so the problem seems to be what's going on with that employment. And you can see here how it relates to inflation. During the pandemic, you, of course, had a massive oversupply of labor relative to demand, because on the one hand, everybody was out sitting at home. And on the other hand, you had all kinds of closures. So there was all kinds of abundant labor and nowhere for it to go. So you can see there was that big spike right at the start of 2020 in labor supply relative to demand, supply outstripping demand by over 15 million workers. It's a very different story now as the reopening has commenced. You can see the gap closing there going into the end of 2020, the beginning of 2021, starts to fuel inflation. And of course, that inflation really goes up in spades when you start to see a deficit that got to right around 5 million workers. It seems to be right around where we're hovering now, give or take. Ostensibly, this is the last leg of this race. This is how you get from around 4% inflation down to 2%. This part of the story needs to get addressed. And of course, because what we're talking about here is labor markets, it's very difficult to address it without a significant shift on the demand side. It doesn't look like there is a supply of labor solution here. It doesn't seem like there is any kind of quick way to go in that direction. There's, of course, conversations about AI eventually helping to fix this, but that's not anything that's going to get off the ground fast enough or be scalable enough for the Fed to actually incorporate it into its thinking over the near-term outlook. There's no conversation about a massive immigration overhaul that would bring in a ton more workers. So there is ostensibly the way to approach this from demand side, which is to say, if there is too much demand for the available supply, and that's causing inflation, because of course companies can only compete then on price, so those that can afford to pay workers more do and get them, and those that can't don't. Perhaps the thing to do is to reduce demand. And if you do that, then the pressure starts to come off and inflation starts to come down. This is exactly what the Fed has been talking about. This is exactly what Jay Powell has been saying all week. Now, of course, what this means is a desire to slow the economy such that the labor market softens. But everything we've seen from U.S. economic data, including today, with that revised set of GDP numbers, suggests that U.S. economic data is actually on an improving path. You can see here, as we surmised a couple weeks back, the breaking of the 20-day moving average on this economic surprise index from Citi did, in fact, find follow-through and continues to show that U.S. economic data is increasingly outperforming relative to forecasts. So the Fed, looking at this, might say, well, if our mission was to hurt demand, demand doesn't appear to be significantly hurt. The markets have, of course, noticed, and this has shown up in policy expectations, where there has been a significant hawkish shift. Take a look here, the dark blue line there, the outlook for where rates are going to be in July. You can see that's been basically flatlining, but the outlook for where rates are going to be at the end of the year in December has steadily increased. And you can see sort of the acts in the play here. This was the run-up in February as we got that better than expected economic data and really had an environment starting to look very adjacent to what we're looking at now. Then this activated the SVB crisis and the banking collapses that we saw there, so policy expectations crashed. And you can see from there, significant rate cuts were expected into the end of the year, at one point as much as 75 to 100 basis points in cuts. As the banking crisis went into apparent remission with the Fed's macroprudential actions to address it alongside the FDIC, and then through May, as we saw the debt ceiling debacle wane and get pushed back past next year's election cycle, this gap has closed to a point where not only did these rate cuts fall out of the outlook, but now we're actually starting to flirt with the idea that rates are going to be higher at the end of the year than they are now. Rate hikes are starting to show up. In fact, it's not just this year. There has been a significant hawkish shift in the overall rates curve. You can see that here as compared to where we were the last time the Fed actually raised rates, which was May. Policymakers pointedly paused in the June outing. So this is what the markets think since the last time they actually acted. And you can see the current and a week ago look about the same and speak to a significantly higher terminal rate. 6 months from now, we're looking at a Fed funds rate closer to 5.5%. That also, more importantly, is giving us a higher for longer perspective because the shift has happened all across the curve. 1 year from now, we're higher than we thought we'd be at the start of May, and 2 years from now, and 3 years from now. So the whole rate structure has shifted higher. But looking at the overall outlook, you can see at this point, we have one rate hike fully priced in by September, 83% chance of one next month, so fairly strong. And in the experience of Fed policy officials, when you get it this high, when it's this far above the 50% mark on likelihood, chances are the hike is going to happen. So at this point, very likely we're going to get a hike in July and at least by September. Looking at this number of hikes cuts column, you can see there's the 83%. There's the one hike already in the market there for September. And that appears to be it, because as you look down, you start to see these numbers get smaller. And come March, you're back to where we are currently as far as the policy range. And then come May, the conversation about cuts starts to happen. But you can then see we have one cut fully baked in for June at this point. And then you start to see cuts multiply. So by July, it looks like you have about almost 2. September, almost 3. And flirting with 4 come the end of next year, such that rates land rather at 4%. So that's about 150 basis points in easing from the peak. On one hand, certainly a more hawkish outlook for the near term. On the other, a very extrapolated rate cut cycle for next year. On one hand, this seems to say everything is going to be a little bit tighter now. On the other hand, it suggests whatever this does will be damaging enough and emphatic enough of a headwind that the Fed has to ease in a hurry, which of course is not what the Fed has been saying. They've been saying that they're probably not going to cut for a period of a few years yet. Now, what's really interesting is that all of this hawkish readjustment has not done more to spook markets. So we can see here the financial stress index from the OFR, the Office of Financial Research within the U.S. Treasury Department. That's near the lows and is actually at levels a little bit lower than they were before the SVB crisis. So here we have where they were at the time that we last had this run-up in expectations around good economic data out of the U.S. Here was, of course, the SVB crisis right there. Here's where credit stress was. Here's where it is now. It's actually lower. So the markets are looking at this and saying, well, all of this is okay, ostensibly because that massive rate cut cycle follows, because the end of the road is visible and because there's a bunch of easing in the tail end. That has understandably given a good degree of cheer to stock markets. Because there isn't really a response that's negative from the credit structure, stocks seem to be perfectly okay with continuing to move higher. And that's seemingly what we're looking at here. But of course, from the Fed's perspective, this is a problem. And it seems to be captured here. We are now looking at, seemingly, a 12-month Fed funds implied rate that is pushing into the current set of target levels. So if the Fed now is aiming for a Fed funds rate in the 5 to 5.25% range, the market seems to be saying variously that when we look at this in 12 months' time, so a year from today, we might be in this very same range. That, of course, clashes somewhat with what we see in other rates expectations, where we do see an aggressive rate cut cycle, and this is where things become really interesting. Because when the Fed looks at this, they say, hold on. We've had this massive hawkish shift in expectations from about the beginning of May. That's this orange line going higher. And yet inflation expectations aren't just not going down. They actually seem to have a bit of an incline. The 2-year break-even rate isn't falling. Tighter credit conditions aren't inspiring bets on lower inflation. So ostensibly, the reaction function from markets is not what the Fed wants to see. Well, the way to address that, one would think, is to scare the markets more intensely. And so, given everything we've heard from Fed officials, especially Chair Powell, over the past 3 weeks, and this state of affairs, the question naturally rises, well, if inflation were to register a bit hotter, given this already, let's call it, less than ideal set of dynamics for the Fed as it stands, what is a central bank to do to get the markets to listen? Is it another 25 basis point hike that's almost fully baked into July's meeting? Or is it something more dramatic to really get investors paying attention and to get these inflation expectations going lower? Well, in so much as this inflation number is not going to answer that question, what it might do is stoke speculation about what exactly that could be amongst financial markets. And so, if in fact this is going to be what sets the framing for how this PCE number is going to come out, and so we get another one that registers north of expectations and gives us higher inflation than what is being baked in, at least for the PCE measure, the Fed might look at this and say, well, how do we get these expectations to come back down? And the markets might look at this and say, well, what is it that they're thinking? How are they going to do this? And if that thinking starts to look like maybe the Fed is going to get more aggressive than the markets are comfortable with, or at least the risk of such a thing feels higher, you probably get a negative response from stocks. You probably get a positive response from the US dollar. And perhaps the place where you could see particularly outsized weakness is gold and other precious metals, which really have a hard time finding appeal in an environment where their qualities as anti-fiat alternatives to paper currency that yield nothing really don't look so much like qualities and look more like liabilities in a world where both the dollar and yields are going higher. And that is Macro Money for today. Last episode of the week. We're here Monday through Thursday, right after overtime with Chris Vecchio, head of futures and Forex here at Tasty Live, where he and I break down the day's events and try to make sense of what's going on. Also on with Chris for Futures Power Hour on Fridays. I'll be there tomorrow. On with Tom and Tony for First Call on Sundays. Writing for the tastylive.com website, and of course also opining on Twitter at Ilya Spivak. Thanks very much for joining, everybody. Have a great weekend. See you next week. Take care.